an opening range gap, and the time zone has to be set to New York, always. All right, so we're going to be looking at this candlestick right here on a 1 minute chart. That's the time frame that's being shown here. So this candlestick, if you take a look at this candlestick's closing price, you can see it up here. And I'm highlighting it here so we can see that the candlestick is basically small little bodiless candle. And I didn't want to hide that by having that little annotation covering it up. So that's your first point of interest, which is previous day's regular trading hour settlement price. That's always going to be, as you can see here, at the 4:14 p.m. Eastern time on a 1 minute candlestick. Here we can see at 9:30 a.m. on the very next day, regular trading hours is going to only show the difference between where we settled the previous day at 4:14 p.m. to now the first opening price at 9:30 Eastern time. Again, all New York local time. So this here shows that we're opening higher than where we settled in regular trading hours, the previous trading day. 9:30 a.m. Eastern time, higher opening price in regular trading hours is classified as a premium opening range gap. The opening range gap is 120 handles or larger, price could leave the gap unfilled. And you have a premium opening range gap, and this is the fib settings, that way you guys can have it real quick reference point. You're going to take the fib and anchor it to the previous settlement price at regular trading hours at 4:14 on a 1 minute chart. You're going to drag the Fibonacci up to the opening price the next trading day at 9:30 Eastern time. Now, obviously, when you have a large gap like this, which is a couple hundred handles between the previous day's regular trading hour settlement at 4:14 p.m. to the opening price at 9:30 Eastern time the following day, with such a large gap like that, the rules I employ is that it's probably going to keep going in the direction of an extreme gap like that. And if it ever, it may not even do this much, but if it ever does trade below that low, usually it's going to stop around the upper quadrant. You can see that here. Okay, so 25% of the opening range gap is usually what you'll see traded there, which allowed me to segue into that smart money concept. When there's a large gap like this, okay, 120 handles is a good ballpark number where it could potentially keep the gap unfilled, meaning that it doesn't come all the way back down to the previous day's settlement price. But it will eventually, at a later time, do that very thing. Now, if you are seeing the market trade higher as we go into an economic report on the calendar, this could usually be kind of like pumping the market up higher. And then at a later time in the same week or the very next day, it can trade down into that level here and maybe go into the middle of the gap, which is consequent encroachment. This is that 50% level here. Eventually, price will want to rebalance all of this here because it's inefficient, because there's no price at all, zero. So this is an actual liquidity void. It's not a buy sign, balance, sell sign, inefficiency. It's an actual liquidity void. It's an actual void because there's no trading, buying or selling between the price of this closing price and where we opened at 9:30 using regular trading hours. Now, obviously, when we start trading at 6 p.m., unless this is a Friday, which it's not because you can see it says Monday, at Monday Eastern time at 6 p.m., the market will open up. And then whatever it does between then and 9:30, that's shown in electronic hours. We don't need to see that here because the opening range gap is defined by regular trading hours only. As soon as you start showing electronic trading hours, what you're looking at there is new day opening gaps and or new week opening gaps. So just make sure you know in your notes, if you're looking at your time reference in the lower right hand corner, regular trading hours is always going to denote what the opening range gap is going to be, if there is a gap. If it's showing electronic trading hours, ETH, then it's going to give you the information that we derive for new day opening gaps and or new week opening gaps. Okay. Obviously, when the market shows a lower gap opening using the same parameters at 4:14 p.m. and we open down 9:30 Eastern time the following day, again using the regular trading hours, this lower gap opening, when we have that at 9:30 Eastern, if that lower opening price in regular trading hours is appearing, then that is classified as a discount opening range gap. If it's this large, again, we have several hundred handles, the 25% of the opening range gap or lower quadrant here, that would be your target, if at all. It may not even trade back to the high or even go back into the opening range gap. So we would use the rules as I outlined when it was a premium opening gap. So let's take us back to that premium opening gap. And I want you to think about how when we're looking at a lower gap opening, we would be drawing the Fibonacci down, whereas at premium opening gap, we're drawing it up. So it gives you the proper classification for the quadrants. Upper quadrant here would be a quarter of the opening range gap. If we are trading in between 20 and 75 handles with an opening range gap, whether it be premium or a discount gap. And again, the classification is only determined by if it gaps higher at 9:30, that's a premium. It's a gap higher. If it gaps lower at 9:30 than where we settled at 4:14, that's a discount opening range gap. Okay. And the only reason that's important is it helps you determine what direction you're going to draw the fib on. So premium opening range gaps are drawn from the previous day's 4:14 p.m. Eastern Time's settlement price up to 9:30 opening next day. Again, toggled on regular trading hours, and reverse it for discount opening range gaps. But if it's 20 to 75 handles, usually if it's a premium opening range gap like this, what I like to look at with electronic trading hours, okay, so this is for your notes, you got to write this stuff down, I'm not going to do everything for you. If it opens higher, I like to see it trade to a pre-market session. That means anywhere between 6 o'clock in the morning Eastern Time to 9:30. All that time there is pre-market. So if we have a premium opening range gap like this at 9:30, I want to see it trade to some overnight London high or relative equal highs, or some high that was formed between 6 o'clock in the morning Eastern Time to 9:30's opening price. So it's going to run buy side initially. And then I would look for it to trade back down into minimum consequent encroachment, which is the red level here, or middle of the gap. And depending upon how I'm bullish or bearish, or if I'm just trading inside of a range, will determine whether or not I'm going to look for a complete gap closure. Everything I'm saying for when it's a premium gap, you're just going to reverse the logic for a discount opening range gap. But here you can see it's the very next day here where that gap higher, that premium opening range gap, it trades up and it eventually comes back down intraday to that 3 o'clock in the afternoon, trades down into that upper quadrant. So you can see how it was not willing to come all the way back down and close in that gap, which would be a perfect delivery to that price. It's not happening here. But it does trade to the upper quadrant of that gap. Now, why is it called the upper quadrant? Because the gap starts here at the previous day at 4:14 Eastern Time and opens here. So since it's an up gap or premium gap, think about this as the range. Well, this is the upper portion of that gap. This is the middle of that gap. This is the lower quadrant of that gap, and this is the low of that gap. So when it's an extremely large gap opening, my interest is only at this upper quadrant. And then I'll see if it wants to have any interest in going back down into the middle of the gap. But 20 to 75 handles, I like the odds of it trading to mid gap. Now there's a sweet spot between 75 and 120 handles where it can go either direction. So I usually err on the side of what do I see in other analysis concepts that is going to help me, because I may have to just sit on my hands and wait till 10 o'clock and not trade anything at the opening range, which is the first 30 minutes of trading between 9:30 Eastern Time to 10 o'clock. So when I have 75 handles to 120 handles or less than 100 handles or so, these are just general rules where I have to lean on what the market has in price, where we are with the economic calendar, and where are we at with seasonal tendencies, the current market structure. All these things have to be referred to when the range is higher than 75 handles. All right. And then obviously the very next day, entirely new trading day, we have another gap here. Now this is the opening range gap, which is very, very small here. But it opens, trades down, comes right back up into it here, and then we break lower. All these lines here are derived from the previous 24-hour session where that opening range gap formed. So that premium opening range gap, that's what these levels are here. So this is the high of that previous opening range gap, the upper quadrant that I said that it would trade down to. You can see it when it did here. And then we just consolidated, hit it once more, and then rallied up. And then the next day at 9:30, so this is 4:14 p.m. on this candlestick right there. Now, if I toggle one more over, now you're looking at this price, which is 9:30 in the morning on Tuesday, January 7th, 2025. We break lower, trade back up into that opening range gap, breaks lower, trades to the upper quadrant of the previous day's opening range gap. Then it goes to consequent encroachment, lower quadrant, and then a complete closure of the previous day's premium opening range gap. And then you can see how the market used all of those levels here and then moved a little bit lower into the session. When you're looking at your regular trading hours chart, you want to highlight every gap. You have a gap here on the 3rd of January 2025. You have the gap that we started this lecture here with, and then that smaller one here that's shaded. And then there was obviously one over here, but you're not going to include that for this discussion. But when the market opened up here, this gap is a liquidity void where it's zero trading, no buying or selling during regular trading hours. So this is an actual liquidity void. When you see moves like this has unfortunately been classified as a liquidity void. It's not actually, because there's actually buying and selling going on inside of that candlestick's range. Over here, for regular trading hours, there is no trading there. During electronic trading hours, there probably is. But for the sake of doing the analysis with regular trading hour charting, when there's gaps like this, the market will want to do patchwork, where it'll deliver back down into it and offer price between these two defined levels, where the previous settlement at 4:14 p.m. Eastern Time to 9:30 the next trading day. Same thing over here. This is a premium gap. This is a premium gap. Okay, so premium opening range gaps start with the fib at the low up to the new 9:30 opening price, just like as we did here. Because it's a premium opening range gap, you anchor it to the closing price at 4:14 Eastern Time, and you draw the fib up, and it shows your quadrant levels where you're going to be utilizing that information. So here, as the market starts to sell off, look how the consequent encroachment offers another shorting opportunity. Mid gap, right here, breaks down, comes back to the lower quadrant of this gap, rolls over, uses the low of the gap, starts to break down and trades into the opening price here, which is the high of this opening range gap, which is a premium opening range gap on the 3rd of January, 2025. So the market trades down into it here, hits the high of that opening range gap there, trades down to consequent encroachment. Look at the bodies. See how they're respecting that midpoint? Then rallies up and then breaks down. Look at the bodies respecting the low of that opening range gap. And then look at the reaction there. Rallies up, takes out the relative equal highs here, and then it's most likely going to want to gravitate towards these relative equal lows here. That's just a little too clean. Things like that, price levels like that don't usually stay intact, and the market will want to go and disrupt that. The smooth edges will be made jagged. So there's some principles, there's some very specific rules that I'm going to be employing. As you can see, not very complex, moved and toggled between electronic trading hours and regular trading hours. But it's not complicated in terms of the logic. So the rule-based ideas that I've applied here, they're very specific. But there's a gray area. It's above 75 handles up to 100 handles or more, but not 120, where I can go both directions. So I'm a little bit more flexible in that range. But anything higher than 120 handles, I'm going to be leery in anticipating that gap immediately being refilled or rebooked to at least half the gap. It can, but I want to have a little bit more information besides just using this information. Remind you that when I was going through all the content, and I'm just briefly going through the slides and explaining that all this stuff was included. You know, these are all very specific things. Okay, number of handles. Okay, how many points filters out whether or not the gap should close in, or how I would use that information. So I went through the effort of trying to show viewers what it is specifically that the algorithm is going to do. Okay, so knowing where the market's going to draw to, that's the most important critical thing, because all of these gaps, all of these concepts, these smart money concepts, they're not going to help you unless you still can read where price is going to go. Now, why did I pick that level? Why did I think it was going to go down there? Well, it's obvious to you now if you've been a student of mine. You can see it's a market maker sell model. Original consolidation, rallies up, accumulation, reaccumulation, smart money reversal, low risk sell, redistribution, second stage distribution. That's what we were at. And then we gap down. Not going to fill the gap because I gave you the logic that the algorithm is going to follow in the previous video. And down she goes, right below that 20,983.75 level. Booyah. Now, this is our opening range gap for Friday's non-farm payroll. We're going to have that information. You can see it clear over here when I take the January 3rd's opening range gap off. Notice that I'm drawing the fib down from that closing price to the open notepad. And every day I have all of these levels. What levels? The levels you're seeing right here. The levels that were over here on the January 3rd opening range gap. The opening price. The midnight opening range. Okay. The opening range of 9:30 to 10 o'clock. All of the quadrants, the consequent encroachment levels, previous day's high, previous day's low, the highest high and the lowest low the previous week, the highest high and the lowest low the last 3 days. These are all things that I have written down. Used it? No, it's not. It's not a coincidence. But let's go on. We're going to take you into the 1 minute chart here. You can see now this is the 1 minute chart of the NASDAQ, March 2025. And this is showing the midnight opening range. Okay, so midnight opening range, it's not a gap, it's just a range, just like the opening range for 9:30 to 10 o'clock Eastern time in the morning session, or when regular trading hours start trading for indices. So if you look at the opening range, this is the lowest low in that range between 12 and 12:30. And here's the highest high of the range in 12 to 12:30. If you use the levels I gave you in terms of projection, it's 0.5 and 0.1 or 0.1. By having that, it gives us a rough idea what the algorithm is going to do, and it's in close proximity to this extreme at -1 that the daily high will form. Now, simple caveat here, okay? If there's ever a day like non-farm payroll, we already know that non-farm payroll is going to have an enormous amount of manipulation. It's going to have a lot of extras in there because the market's going to be pushed around and intervention is going to go through the roof. So because of that, these numbers won't be as precise on a FOMC day or a non-farm payroll day. So just know that, and like a CPI day too. So those are kind of like heavy hitter days, and you just got to be aware that it might not be as perfect as it would be on other days. So with that caveat introduced, we're going to look at it now. All right, so you can see how the market did in fact rally up. Just went beyond the -1 standard deviation of the midnight opening range, then broke lower, created a fair value gap right there, and notice how that delivered to consequent encroachment of that gap and -0.5 level. And then it drops off precipitously and trades down into predetermined ranges that I've already taught you how to use now. And here is the later in the morning session. You can see all of that that drop down I just showed you in the previous slide. We went to here, then we went up into the midnight open range or opening range and worked all the levels in between the high and the low and shaded in the purple. And then in here, right before non-farm payroll at 8:30 Eastern time, Friday morning, the market does its little stop run, and anyone's short, and I was short initially with one contract, and then, or with a micro, and then it stopped me out, and then I went in again after getting stopped out because I understand what it's likely to do. And that huge pool of liquidity I outlined on Thursday night ahead of non-farm payroll was absolutely going to be delivered. And I was going to aim for that, but I don't want to ride through the 8:30 all the way to 9:30. So I'm just going to take something that makes sense, to make a nice little chunk of change without risking a whole lot of money. And it was with real money when I did it. So make sure you understand that. But it was a really, really nice drop. And you can see here, now notice this says micro, okay? Micro means it's $2 per point. I went short here, trading in a fair value gap, and then it ran up above here, taking my stop, rallying a little bit higher, and then I wanted to see it go short from there. After taking my stop, I felt confident that, okay, I was premature. It wasn't much money. It was literally like 60 bucks or not even that really. And then it breaks aggressively lower after entering 3 contracts of the micro. And then I took my profit down here just in the same 1 minute interval. So in 1 minute, it was like $1,000, just like bang, just like that, using micros. See your comment again. You're welcome to keep leaving more though. All right, so later in the day, okay, later in the day, when we get through 9:30 opening bell and we start working inside of that opening range between 9:30 and 10 o'clock, now this is the part where I use the next participation phase of this model, which is first presented fair value gap. That's what we're doing here. So if you look at the gap right here, you see that? What that also overlaps with is if you see this wick, this is a discount wick. But when price is below it, that discount wick becomes an inversion premium now, right? So the market trades up into it. Even if there was no gap there, I would use that level in and of itself of the video teaching about opening range gaps. So here, this is the very first presented fair value gap of the morning. Since 9:31, it can't be the gap. If it forms on 9:30 candle, you have to wait. That was the rules for Caleb. Well, you can see this here, too early. This is the first one. So in this little shaded area here, that's my first presented fair value gap. Now, you might look at this and say, well, you got that drawn differently. I'm drawing it like that because I'm not going to just use that wick high. I'm going to use this overlap of these 2 candles bodies because I want to get as close as I can to these relative equal lows, but still use the framework of the fair value gap, not TikTok, whatever, Instagrammers. So you can see that I wanted to go short here. And now because we're not trading the non-farm payroll, this is after that 8:30. So we're inside of the opening range between 9:30 and 10 o'clock. So between 9:30 and 10 o'clock, that 30 minutes, I'm waiting for that first fair value gap. But what direction am I trading in? That purple line. That's that level I told you on Thursday night. So that's the draw on liquidity. I'm not interested in going long. I'm not interested in just seeing the market trade below these relative equal lows. I'm not interested in that. I'm interested in the market dropping aggressively into that purple level at 20,983.75. That's what I'm aiming for. That's the very thing I'm anticipating price to deliver to. I'm not trying to be long. I'm not trying to buy. I'm not trying to go long. Okay, I'm not trying to look for reversals. I'm not expecting these moves just to go below these relative equal lows and peter out and go higher. I'm not looking for it to go below this low and be done. I'm looking for it to have a sustained price run to that purple level there. And that's why my entry is here at 21,123.25 and covering on a limit as it breached at 20,975.75, which is below 983.75. And of course, this is not micro. These are mini contracts now. So it's a little bit different, just a little shy of 12,000. If you had taken that trade, that's what you could have scratched the itch with.